Preparing for a finance manager at Orange interview? You've reached Candy Mentor, and this video is for you. We'll walk through 20 key questions you're likely to face. For each question you'll see a sample answer followed by the key points to cover. Subscribe, like, and share, and drop a topic request in the comments. Question 1. Tell me about your experience and why you want to become a finance manager at Orange. I am a finance professional who combines strong reporting discipline with practical commercial judgment. In previous roles, I owned budgets, forecasts, month-end analysis, and performance discussions with operational leaders. I have also improved reporting processes and coached analysts, which strengthened both control and decision-making. Orange appeals to me because telecom finance connects recurring revenue, major network investment, customer experience, and digital growth. I would bring reliable numbers, constructive challenge, and a clear focus on profitable execution. While answering, focus on your progression, ownership of planning and reporting, leadership style, commercial partnership, and motivation for joining a large telecommunications group undergoing digital, network, and customer-focused transformation. Question 2. How would you build an annual budget for an Orange business unit? I would begin with strategic objectives and translate them into operating drivers: subscribers, churn, ARPU, traffic, handset volumes, headcount, energy costs, and network investment. I would involve commercial, technology, and operations leaders early, separating committed costs from discretionary choices. After building base, upside, and downside cases, I would challenge assumptions against historical trends and market evidence. Finally, I would secure ownership, document assumptions, and establish monthly variance reviews so the budget remains an active management tool. Make sure to cover the planning calendar, driver-based assumptions, revenue and cost ownership, operational volumes, network investment, scenario analysis, challenge sessions, approvals, and clear accountability for monthly tracking. Question 3. What KPIs would you monitor in a telecommunications finance role? I would use a balanced dashboard rather than focus on revenue alone. Core indicators would include service revenue growth, subscriber additions, churn, ARPU, EBITDA margin, operating cash flow, CapEx intensity, customer acquisition cost, and net promoter or service quality measures. I would also examine prepaid and postpaid mix, enterprise performance, and network utilization. The key is linking operational movements to financial outcomes, for example, whether a retention campaign lowers churn profitably rather than simply increasing marketing spend. In your answer, talk about revenue growth, ARPU, churn, subscriber additions, EBITDA, cash flow, CapEx, customer acquisition cost, network utilization, service quality, and how financial and operational indicators connect. Question 4. How do you explain a monthly forecast variance to senior management? I first separate the variance into price, volume, mix, timing, and one-off effects, then quantify each driver against budget and the latest forecast. For example, a revenue shortfall could reflect lower subscriber additions, higher churn, or delayed enterprise billing. I validate the explanation with the business owner, assess whether the impact is temporary or structural, and translate it into an updated outlook. My management summary would state the cause, financial consequence, action, owner, and expected recovery date. Be sure to mention materiality, root cause analysis, price volume mix decomposition, timing versus permanent effects, ownership, corrective actions, updated forecasts, and communication that is concise, factual, and decision-oriented. Question 5. Describe your approach to month-end close and management reporting. A strong close starts before month-end. I maintain a timetable with clear owners, confirm major accruals and cutoff requirements, and reconcile key balances such as revenue, receivables, payables, payroll, and capital projects. I review unusual movements using trend and variance analysis, then ensure journals have support and appropriate approval. Once the ledger is reliable, I produce concise commentary explaining performance, risks, and actions. I also look for recurring manual steps that can be automated without weakening controls. While answering, focus on close planning, reconciliations, accrual completeness, cutoff, review controls, materiality, automation, timetable discipline, and converting accounting outputs into useful performance commentary. Question 6. How would you forecast revenue for Orange's consumer mobile business? I would build revenue from customer economics rather than apply a simple growth percentage. The model would forecast opening subscribers, gross additions, churn, migrations, and average active customers by segment. I would then apply ARPU assumptions, separately considering price changes, promotions, data usage, prepaid behavior, and device or bundle mix. I would reconcile the operational model to billing and accounting data, test seasonality, and run sensitivity cases for churn and competitive pricing because small customer movements can materially affect earnings. Make sure to cover subscriber cohorts, gross adds, churn, migration, ARPU, promotions, prepaid versus postpaid behavior, device effects, seasonality, and reconciliation between operational drivers and reported revenue. Question 7. How would you evaluate a major 5G network investment? I would assess the investment through incremental cash flows, not total network spending. Benefits might include higher customer retention, additional data revenue, enterprise contracts, capacity savings, and lower future maintenance costs. I would model construction timing, useful lives, OPEX, tax, working capital, residual value, and downside cases for delayed adoption or pricing pressure. NPV and IRR would support the decision, but strategic coverage and service quality also matter. After approval, I would compare benefits and milestones with the original business case. In your answer, talk about incremental cash flows, coverage and capacity benefits, customer and enterprise revenue, OPEX savings, NPV, IRR, payback, strategic value, risks, and post-investment performance tracking. Question 8. What is the difference between capital expenditure and operating expenditure in telecoms? Capital expenditure creates or enhances an asset that provides benefits over multiple periods, such as radio equipment, fiber infrastructure, software development meeting capitalization criteria, or a major network upgrade. Operating expenditure supports current operations, including maintenance, energy, customer service, and routine repairs. CapEx is capitalized and depreciated, while OPEX generally reduces current earnings. The distinction affects EBITDA, cash flow presentation, and future depreciation, so I would apply accounting policy consistently and challenge attempts to capitalize ordinary operating costs. Be sure to mention asset creation, future economic benefits, recurring service costs, capitalization criteria, depreciation, EBITDA impact, cash timing, policy consistency, and examples such as network equipment, leases, maintenance, and energy. Question 9. How would you manage working capital in a telecom business? I would segment working capital by driver and owner. For receivables, I would monitor billing accuracy, aging, collection effectiveness, payment methods, disputes, and expected credit losses. For inventory, I would track handset turns, obsolescence, and purchasing against demand. I would also review supplier terms, accrued costs, and contract liabilities from customer prepayments. A weekly cash view for material movements would complement monthly reporting. The objective is sustainable cash conversion, not simply delaying suppliers or restricting commercially valuable stock. Focus on receivables, collection rates, bad debt, supplier terms, handset inventory, contract liabilities, billing accuracy, cash forecasting, cross-functional ownership, and balancing liquidity improvements with customer and supplier relationships. Question 10. How would you assess a proposed customer pricing promotion? I would compare the promotion with a no-action baseline and calculate incremental customer lifetime value. The analysis would include expected gross adds, churn reduction, ARPU dilution, discount duration, device subsidy, acquisition costs, network usage, cannibalization, and likely competitive response. I would test base, upside, and downside conversion assumptions and identify the break-even retention or volume level. Approval should include clear eligibility rules, a limited duration, reporting ownership, and a post-launch review comparing actual contribution margin with the original business case. In your answer, talk about incremental customers, retention, ARPU dilution, duration, cannibalization, acquisition cost, margin, lifetime value, competitor response, controls, and measuring actual results against the proposal. Question 11. What financial controls are especially important in a telecommunications company? The most important controls protect the completeness and accuracy of high-volume transactions. I would prioritize billing to ledger reconciliations, product and tariff master data governance, revenue cutoff, cash collection, refunds, procurement approvals, supplier validation, and access segregation. Capital projects also need authorization, project cost tracking, and capitalization review. Automated exception reporting should identify unusual credits, manual adjustments, or dormant access. I would test both design and operating effectiveness, document evidence clearly, and remediate root causes rather than repeatedly correcting symptoms. While answering, cover billing completeness, revenue recognition, cash and bank controls, procurement, access management, data integrity, capital projects, reconciliations, segregation of duties, and evidence suitable for audit. Question 12. How would you handle a disagreement with a commercial director over a forecast assumption? I would first understand the commercial rationale and separate the disagreement into facts, assumptions, and judgment. Then I would bring relevant evidence, such as historical conversion, churn behavior, competitor pricing, or market data, rather than relying on personal opinion. If uncertainty remains, I would present scenarios and show the financial consequences of each choice. We could agree on a base case, document the upside and downside triggers, and define when to revisit it. Constructive challenge should improve the decision, not damage the partnership. Make sure to cover listening, shared objectives, evidence, transparent assumptions, sensitivity analysis, challenge without confrontation, escalation thresholds, decision rights, and preserving the relationship after the discussion. Question 13. How do International Financial Reporting Standards 16 leases affect Orange's financial statements? Under International Financial Reporting Standards 16, most operating leases create a right-of-use asset and a corresponding lease liability. For Orange, relevant examples may include stores, offices, towers, vehicles, and other network locations. Instead of a straight-line rental expense, the income statement generally shows depreciation and interest, which increases reported EBITDA but introduces balance sheet and financing effects. I would focus on complete lease data, accurate terms and renewal options, discount rates, modifications, and reconciliations between the lease system and general ledger. Be sure to mention right-of-use assets, lease liabilities, discount rates, depreciation, interest, EBITDA effects, telecom sites and stores, modification controls, data quality, and implications for cash flow and performance analysis. Question 14. How would you approach impairment testing for telecom network assets? I would begin by identifying impairment indicators, such as sustained market decline, technology disruption, regulatory changes, underused capacity, or deteriorating forecasts. Assets are tested at the appropriate cash-generating unit level, comparing carrying value with recoverable amount based on value in use or fair value less costs of disposal. I would challenge subscriber, ARPU, margin, CapEx, terminal growth, and discount rate assumptions, then run sensitivity analysis. Clear documentation matters because impairment conclusions often involve significant judgment and audit scrutiny. In your answer, discuss cash-generating units, indicators of impairment, value in use, fair value, forecast assumptions, discount rates, sensitivity, technology obsolescence, and transparent documentation of judgment. Question 15. Tell me about a time you improved a finance process. In one role, the monthly forecast depended on manually consolidated spreadsheets, creating delays and version control risk. I mapped the process, removed duplicate inputs, standardized driver definitions, and introduced a controlled reporting template linked to a central data source. I involved users in testing and retained review controls before changing the workflow. The close became 2 days faster, reconciliation issues declined, and managers received more time for analysis. I also documented ownership and training so the improvement did not depend on one individual. Focus on the original problem, root cause, stakeholders, control considerations, technology or standardization, measurable benefits, implementation challenges, and how you ensured the improvement remained sustainable. Question 16. How would you prepare a downside scenario for Orange's financial plan? I would start with realistic risks rather than reduce every assumption by an arbitrary percentage. For example, I might model higher churn, slower subscriber additions, price competition, energy inflation, delayed enterprise contracts, and slower network monetization. Each operational assumption would flow through revenue, EBITDA, CapEx, working capital, and cash. I would identify controllable mitigations, such as phasing discretionary spend, and define trigger metrics and decision dates. Management should see both the quantified exposure and the actions available to protect liquidity. While answering, cover the key risk drivers, linked operational assumptions, customer and pricing sensitivity, cost flexibility, liquidity, mitigation actions, trigger indicators, and distinguishing a scenario from an unsupported pessimistic forecast. Question 17. How do you ensure accurate revenue recognition for bundled telecom contracts? I would apply International Financial Reporting Standards 15 by identifying each promised good or service, such as connectivity, a handset, installation, or a material loyalty benefit. I would allocate the transaction price using relative standalone selling prices and recognize revenue when each performance obligation is satisfied. Upfront discounts can therefore affect the timing of handset and service revenue. I would also control contract modifications, promotional data, and billing interfaces, then reconcile recognized revenue to operational volumes and the general ledger to detect completeness or mapping errors. Be sure to mention International Financial Reporting Standards 15, performance obligations, allocation of transaction price, standalone selling prices, handset and service components, contract modifications, loyalty benefits, and billing to ledger reconciliations. Question 18. How would you lead and develop a finance team at Orange? I would set clear expectations for accuracy, timeliness, insight, and stakeholder behavior, then align responsibilities with each team member's strengths and development goals. Regular one-to-ones would combine coaching with honest feedback, while review meetings would focus on root causes rather than blame. I would rotate analysts through reporting, forecasting, and business partnering to build broader capability and succession depth. I would also protect time for process improvement, because a team that only produces reports has limited capacity to influence decisions. In your answer, talk about role clarity, technical development, coaching, feedback, succession planning, workload management, collaboration with business teams, psychological safety, and accountability for accurate, timely delivery. Question 19. What would you do if you discovered an error in a forecast already presented to the CFO? I would validate the error quickly, quantify its impact, and determine whether it affects the current period, forecast, or a management decision. If material, I would tell my manager and the CFO promptly, clearly explaining the original figure, corrected figure, cause, and implications. I would avoid defensiveness and provide a practical remediation plan. Afterward, I would perform a root cause review, strengthen the relevant review or data control, and communicate the lesson to the team without creating a blame culture. Make sure to cover immediate validation, materiality, transparency, corrected numbers, cause analysis, control improvements, communication timing, ownership, and avoiding concealment or unnecessary alarm. Question 20. What would be your priorities during your first 90 days as finance manager at Orange? During the first month, I would learn the strategy, operating model, reporting calendar, key KPIs, systems, and stakeholder expectations. In the second month, I would assess forecast accuracy, close controls, major risks, team capability, and the quality of business partnering conversations. By the third month, I would agree priorities with leadership and deliver one practical improvement, such as clearer driver reporting or faster reconciliations. My goal would be to build credibility through listening first, then improve insight, control, and decision speed. Focus on understanding strategy and operating drivers, meeting stakeholders, reviewing close and forecast quality, identifying control or data gaps, learning local priorities, delivering an early improvement, and building trust before changing processes. If you are still with us, congratulations. You are much ahead of the rest and serious about preparing for your interview. We hope we were able to add value to your preparation and create some helpful content. Do not forget to like and share this video. Your small act can do great things for us.